Hey everybody, welcome back to another Hughes Retirement Group video. I wanted to do a follow-up video on our past video of the taxable, tax-deferred, and tax-free buckets. And I wanted to show how that would apply in reality to potentially finding yourself or positioning yourself in a tax-free or tax-efficient retirement. So as a follow-up on these buckets of money, for those who did not watch the previous video, we highlighted taxable, tax-deferred, and tax-free. And if we kind of go through here and we look at the taxable buckets of money, those things that are basically generating you a 1099. So sometime in February, you're getting a letter from the IRS essentially saying, hey, you owe us money based off the gains that your money has produced. So you have a capital gains tax. So if you had, let's say, a $10,000 cost basis, the portion that you put in, and you had a $1,000 gain, only that $1,000 gain would be taxed. And typically that's at a 0, 15, or 20% tax rate, depending on what your income is. If we take a step forward to tax deferred, you can see we've got 401ks, 403bs, traditional IRAs, and all of this is taxable upon withdrawal. So whatever tax bracket we are in at that time, that's what we're going to be subject to from a tax standpoint. And then if we go to the tax-free bucket where we have Roth or Roth conversions, maybe you have a 401k Roth at your company, or maybe you've utilized properly structured life insurance to create a tax-free cash value, then all of those potential or future gains would be tax-free if done correctly. So if you put in $100,000 and you made $50,000, all of it would be tax-free if the rules and regulations behind the Roths were fulfilled. So if we take a look here at 2020 and the standard deduction, we can see that it's $27,400 for a married couple over 65. So this is important because we want to use the standard deduction to our advantage in our retirement. So when we're positioning these assets accordingly, we want to position them based off of what the standard deduction is. So if we take a look here once again at the buckets and we said, okay, what kind of mathematically ideal amount do we want in each one of these buckets so that we can have tax efficiency or potentially a tax-free retirement? Here's what we would do. So typically we would say 6 months to 12 months living expenses in our taxable bucket. So if we have a brokerage account or individual stock or checking, savings, money markets, whatever they may be, we want 6 to 12 months living expenses. Our tax-deferred bucket, this is the key point to getting to tax efficiency or tax-free, because we don't know what future tax rates are going to be. But let's say right now, once again, the standard deduction is $27,400. Let's say we found a mathematically ideal amount. And once again, this is geared more towards people who are married and over 65 and getting that standard deduction. But the idea is that in retirement, when we're converting these tax-deferred buckets into income, we want to pay as little tax as possible. So with the 401k or the traditional IRA, any of those tax-deferred bucket, the idea behind it is to have it equal to or less than our standard deduction. So for instance, and we're not even going to flirt with the full $27,400, let's say we had $500,000 and we knew that we were going to take out 3.65%, because right now that's what RMDs are. Basically, what that's going to do is that's going to make us take out about $18,000 roughly each year. So that $18,000 obviously is less than the $27,400. So if our standard deduction is $27,400 and we're taking out basically $18,000, we can obviously look and say that we are $9,400 in the clear from a tax standpoint. So now all of a sudden when we start taking Social Security, if that's our only other source of income, we're potentially netting more income because we've positioned our assets properly. And if we take that one step forward to tax-free, let's say we have everything else in tax-free and we've positioned over a period of time from our tax-deferred to our tax-free. We've done Roth conversions. Maybe we have some properly structured life. We've got everything in this tax-free bucket. Even if it's $1 million, everything that we take out from income is tax-free. And it doesn't show up as provisional income, which is what the government looks at from a Social Security taxation standpoint. It doesn't show up as ordinary income, but you get to take those withdrawals, real money, tax-free to you. So you've taken this $18,000 distribution, $18,000 and some change, you've made it less than your standard deduction. So essentially you've contributed to this 401k or 403b throughout the course of your life, and you've taken a deduction on your income. You've contributed, taken a deduction, grown it tax deferred, and withdrawn it tax free if done properly. So once again, finding that mathematically ideal amount in that tax deferred bucket and then shifting everything else to tax-free can put you in a position to have a tax-efficient or tax-free retirement. Hopefully you found this information to be useful, and you can apply some of these tools and techniques to position yourself in a tax-free or tax-efficient retirement. As always, if you enjoyed the content, feel free to like, subscribe, or share. And remember, as always, if you don't have a plan for your money, the government does.